Just a few years ago, stablecoins operated almost exclusively as high-frequency lubricants for algorithmic trading bots in the crypto market. During that era, the ecosystem was heavily reliant on a few tech-focused banks. When Silicon Valley Bank collapsed in 2023, the sudden loss of reserves caused major digital dollars to break their one-to-one peg. Legacy networks like SWIFT take days to settle international transfers. To bypass that friction, multinational companies are moving a $315 billion digital asset market out of the speculative shadows and turning it into mandatory global infrastructure. To fully understand how digital money functions as reliable infrastructure, we have to look at the mechanics of the peg. How does a piece of internet code hold its value at exactly $1? This diagram illustrates the dominant fiat-backed model. Over 99% of the market operates on this highly capital-efficient one-to-one digital IOU, where every token is backed by physical cash or a U.S. Treasury bond. But this introduces custodial risk. The digital dollar is only as secure as the physical bank holding those reserves. If the custodian fails, the token fails. Alternative designs, like the synthetic stablecoin model, avoid traditional banks by using highly complex crypto hedging to generate high yields. However, when crypto funding rates turn negative, these synthetic protocols are forced to rapidly overhaul their reserves and pivot back to real-world assets to stay solvent. Securing these peg mechanisms is an absolute prerequisite. Global corporations will not move supply chain settlements over blockchain rails unless the underlying asset is completely stable. With the design of the token settled, the competition has shifted to the rails themselves. Technology and payment giants are now building the full-stack infrastructure required to move these assets. Stripe acquired infrastructure firms and launched its own proprietary blockchain called Tempo. Tempo is optimized specifically for payments, achieving transaction finality in under a second. Look at this workflow mapping Tempo's economic model. Instead of forcing a company to hold a volatile cryptocurrency like Ethereum just to pay the network fee, Tempo deducts the cost directly from the stablecoins being transferred. Meanwhile, PayPal rolled out its regulated PYUSD token to 70 global markets. A merchant accepting an international payment receives their funds in minutes, entirely bypassing the multi-day delays of correspondent banking. By owning the digital wallet on the user's phone and the blockchain network validating the transfer, Silicon Valley has successfully constructed a parallel set of global monetary rails. This frictionless, high-speed environment solves the problem of traditional bank runs, but it introduces an entirely new category of automated danger. AI agents now use stablecoins as their native currency. In an emerging sector called agentic commerce, autonomous programs execute synchronized microtransactions, autonomously purchasing cloud computing power and raw data without human oversight. These networks rely on oracles, external data feeds that tell smart contracts the current price of assets. If a single oracle is compromised or feeds stale data during a flash crash, it can trigger massive, unnecessary liquidations across the ecosystem. We are looking at the risk of algorithmic contagion. A bug in an AI's trading logic could create a sudden imbalance in on-chain liquidity, sparking a mechanical depegging event far faster than any human regulator could detect and intervene. The sheer speed of these automated networks, combined with the market's massive projected growth, turned this digital infrastructure into a matter of national financial stability. With the dollar's global reach at stake, Washington intervened through the landmark Guiding and Establishing National Innovation for U.S. Stablecoins, or GENIUS Act. The act legally classified these tokens as payment stablecoins. By defining them as payment instruments rather than securities, lawmakers stripped jurisdiction away from traditional agencies like the SEC and handed it to banking regulators. The ultimate authority now rests with the Stablecoin Certification Review Committee. Chaired by the Treasury Secretary, this body acts as the gatekeeper, deciding exactly who is permitted to issue digital money. The committee serves a highly specific defensive purpose. It prevents non-financial monopolies, like social media or e-commerce giants, from minting their own unbacked currencies and creating systemic risk. The GENIUS Act is a deliberate strategy. The U.S. government is leveraging private sector innovation to extend the reach of the dollar into smartphones worldwide. Domestic regulation in the United States is merely the opening move in a massive three-sided global money race. The U.S. is playing the hare strategy. It relies on the speed of private tech companies to push dollar-backed stablecoins deep into emerging markets, specifically targeting cross-border payments. China is playing the tortoise.
Through the ECNY and a multi-currency unified ledger known as mBridge, the state is slowly building a centralized, sanction-proof alternative highway for global trade. And then there is the Rhino. Legacy commercial banks on Wall Street are deploying tokenized deposits, putting traditional bank liabilities on blockchains to ensure their two-tier credit system survives the transition to digital rails. End users rarely care about the underlying architecture. Businesses and consumers will naturally adopt whichever payment rail offers the fastest settlement, the lowest cost, and the highest security. Money is now a programmable primitive moving at the speed of information. Whoever wins this competition will control the financial ledger of the 21st century.